Hey guys, what's going on? It's Henry back with another video, and in today's video we're going to be talking about buying put options. I typically don't love to buy put options, but boy are the markets red. I'm down some money, Cathie Wood down some money, Warren Buffett down some money. Everyone is just losing money. The federal government is going insane. Interest rates are going insane. Inflation rates are going insane. So we have a lot of problems here, and we have to solve some of these problems. And unfortunately, one of these problems can be solved through buying options. And I'm not a fan of buying options, but I think buying put options actually makes sense because look at the futures. The futures are down 2.4%. Seems like the market is just lower every single day. Tesla's going down. Amazon after the split actually went up, but it's continuing to go down. NIO is actually okay, but it's also going down. So I want to make sure I show you guys how to protect your portfolio. I have not been buying puts. I've been against this strategy, but to be honest, I kind of feel like an old dog that needs a new trick, and I do know how to buy put options. And I didn't want to believe this myself, but if this market gets worse, at least buying put options will completely hedge all of your positions, in fact, and it'll make you some alpha in this bear market. So let's talk about buying put options and how to do it properly. So step number one, you really want to find a stock that you think is going to go down, and this could be a number of names right now. It could be the tech stocks, because the tech stocks are pretty overvalued. They have very high price to sales ratios, high price to earnings ratios. They don't have as much social velocity. Everyone seems to be very bearish, and you kind of want to move with the market. What I mean by moving with the market is when other people are selling, you want to sell. And when everyone is buying, there's a momentum spike towards the upside, you want to get in and buy. But right now in this selling pressure, what we want to do is buy put options. Let's go over some specific examples. Looking at Apple, I can't really believe Apple can fall any further, but Apple could be a good play. I'm going to take a look at a few different plays. $132. In the past week, this stock is down 9.62%. And I don't even think that it was overvalued to begin with. It just shows you how much fear there is in the market, down 16% on Apple. A blue chip company that everyone basically likes is down a whole lot. I don't know if Apple's going to keep falling, but I want to buy some put options on something really risky, and something that I'm going to potentially look at is Coinbase. So many YouTubers pushed Coin. I have not been a fan of Coin at $300, but goodness, I did not think it's going to fall down to 51. Who knows? This thing could be going down to like 20 bucks if you take a look at Bitcoin. So if I take a look at Bitcoin, $23,975, that seems unreal. People were saying that this thing is going to be like $100,000 or $500,000. Everyone was invested in crypto. Now, again, I've lost some money. I'm not an angel or like the best, smartest person in the world. I'm just a normal human being, but at least I was not in some of these risky plays. But at least my fear kind of kept me away from Bitcoin. I'm really happy about that, but I don't even know. Bitcoin is an asset class of its own. But anyways, as this thing goes down, Coinbase is not going to be making as many fees. So let's open up Coinbase and see what buying a put option on Coinbase looks like. Again, it seems unreal. Most people will say that Coinbase is a good value buy right now. They'd say, well, Coinbase, my average cost is $250, $270, $140, $110. This thing is undervalued. But just because you bought a stock at a higher price does not mean that it's undervalued. Just because it's down 50% from where you bought it still doesn't make it a good purchase. In fact, just because it's down 70% in the past 3 months still doesn't make it a good purchase. It could be down, 99%. We've seen all kinds of things happen in the market, especially in the crypto market, like Luna. I think it's down like 99% or something like that. So anyways, what you want to do if you have a position, let's say you have a position in Coinbase, you could have a position in any stock. Let's just say you want to protect your position. You want to guarantee that you can get out of the stock at a certain price. So say you got a stock at $100 and it went down to like 70 and you're like, oh geez, I hope it doesn't go down any further. I really want to protect myself. If it goes down below 60, I want to guarantee myself I can get out at 60. Well, that's actually buying a put option. Buying a put option bets that a stock is going to go down. It is a great hedge in a portfolio because if the market goes lower, your puts print money. They make cash. They basically appreciate in value. They literally rise when the market falls. They do the inverse of what the market is doing. So if the market's going down, you're making money. If the market's going up, these put options will cost you some money. But anyways, let's look at Coinbase. Let's say over the past 3 months, this stock was $189. Jeez. And now it is at $51. Let's just say you want to guarantee yourself it cannot go below 50. You're like, at 50, I'm out. Or let's just say you don't even know how long it's going to go down for. Let's just say you want to profit off of a stock falling. And And you can use a different stock. Again, I'm not a financial advisor. I'm just showing you what I would potentially do, and I'm educating you on options. You make the plays that you think are the smartest using your own fundamental and technical analysis, or you can always follow mine in the Discord community. The Discord community is in my description. But okay, let's go buy a put option. So I'm gonna click put option right here. You can buy a put option that goes out for 1 week, 2 weeks, 3 weeks, 4 weeks. You can go up to 3 months, 6 months, and 1 year, okay? There's a lot of different expiration dates that you can pick, and they are very important. All of these expiration dates are different. They have different time decay, they have different deltas, they have, potentially you're gonna wanna go for different strike prices. Let me show you the best practices, okay? One thing is first, in the market right now, we are seeing a bearish move downward. Futures are red. And to be honest with you, I'm kind of afraid because, I need this money, I live on this money, and a lot of people don't want to lose their hard-earned dollar, and we don't know how much lower the market will go. So let's go for a shorter term option, okay? It could be June 17 or June 24th as I'm making this video. Let's just say we're gonna go 2 weeks out, okay? I wanna protect myself these next 2 weeks. The current price is about $51.40. However, when the market opens, it's probably going to be lower, which is not a good thing. Despite Robinhood loading this up right now, we don't really care because what I really care about is the 50 strike. I think this is going to have a lot of volume. 402 volume. Open interest is 987. Implied volatility, I have never seen this type of implied volatility literally since like 2008, and I was not even investing in 2008. I mean, some stocks have had this high volatility, but I don't even think Tesla had this type of volatility even around earnings. So this is pretty insane. It just shows you how fearful the market is and how much implied volatility we're really in right now. So 154, this is insane. That is a bad thing because options are going to be expensive, but hey, they're expensive for a reason because there's so much fear. And to be honest, the market could go down, another 10, 15 points, who knows, right? So if it were to go down, this position would start profiting. Now there is a way to do this. You don't want to hold this option up until expiration. A lot of people say, how do I close out this position, Henry? And my answer to that is it depends, and I'll tell you some different scenarios. First, let's just say you buy this $50 put option, okay? So if the stock goes down below 50, you can sell it at 50 if you have the stock, but you can also trade options. You don't have to have the stock. You can just trade the option itself. You can buy a put option and be bearish on any stock out there that has options. So let's just say you don't even have coin. I don't have coin. So I want to buy a put option on coin, $50 strike. The bid-ask spread is pretty good, $2.40, $2.65. I am looking for a tight bid-ask spread. That is because when I'm trading, I want to make sure that I'm not losing too much money in slippage. Now, kind of similar to cryptocurrency, there's a slippage in the market. Basically, slippage is, yeah, it's trading for $2.40, but $2.65 on the ask. So if you want to end up buying this, you can't buy it for $2.40. You actually have to buy it closer to $2.65. Now the delta here is 0.23. That means this option has a 23% chance of expiring in the money. That's not actually a high chance, but it's actually very close to the money. So this already looks like a good deal to me. It's at $51. This option strike is 50. It only has to move down by $1, and you're telling me that's a 23% chance. Now I will say there is a 23% chance. Now taking a look at theta is pretty high. I mean, basically if you multiply this by 100, because each option is 100 shares, then this theta is $21, meaning that every single day that is decaying by $21. But in this volatile market, the market's moving like 10%. A 10% move in Coinbase is like a $5 move. A $5 move if you multiply it by delta. The reason why I'm multiplying by delta, by the way, is because I'm going to show you how this option moves, how this premium changes. You buy it for $2.53, and if this stock goes down by $5, actually let's just say $10, this stock goes down by 20%, it just went down 20% in one day. So absolutely can do this in 1 week, right? So let's just say 20% down. Okay, that is a $10 move. You multiply that 10 by the 0.23 delta, which is $2.30, right? Basically, that is what this option is going to change by. It's going to move from $2.53 down by $2.31 extra. Basically, this option is going to go from $2.50 up to $5. You're going to literally double your money if this stock moves by 20% in a week, which it just did in a single day. So essentially, this option is moving 5 times more than the stock. So now going back to what the option is going to do, if the stock moves by 1%, you're going to make 5%. If it goes down by 2%, you're going to make 10%. If it goes down by 5%, you can actually make 25% in a week. Now, the way I would do this is I would actually only wait about few days for this option in your hands, right? So let's say that you buy it on Monday or on Tuesday. I would wait until like Thursday or Friday and get rid of this option and not even go until next week. Like let's say the option expires next Friday, not this Friday, and today is Monday. Then I wouldn't even wait until until next Friday. I would literally close it this Friday. I would not take it into the weekend because over the weekend, a lot can happen and you are losing some theta or time decay of the option. And since you're buying the option, you really want to preserve this option as much as possible and not really have it go up until expiration unless coin continues to move lower and lower and lower every single day and you think that it can continue moving lower. But let's just say you buy it on Monday, it's expiring next Friday. I would literally cut this position on Thursday or Friday. I would aim for a profit target of 50 to 100%. What that means is you're buying this put option at $2.53 at $3.75, I'd probably cut it. So let's say you put 2.5K. Once it hits $3,750, I take the money off the table. And that's because a 50% return in 1 week is obviously insane. I've done my job and I don't need to hold it until expiration, because what ends up happening is when you get too greedy, this option can start going against you because a stock will move down a few days, right? And then it'll have a big explosion up and it can continue going down. But still, if you have a few days that go down, I wouldn't really press your luck. I would take a 50% gain, 75% gain, or 100% gain. Turn 250 bucks into 500, or turn, $2,500 into $5,000. At that point, I would go. I wouldn't really push my luck much further. So that's what I would do with Coinbase in this scenario. Now, there's a few other stocks that I would potentially put on your watch list. So check this out. I would put Disney on your watch list. With Disney, you can buy some put options. Amazon, surprisingly, has had a stock split, which in most cases is a really good thing. And it has been a good thing the day after the split. So I told a lot of my Discord members to buy Amazon. That was easy money. But as the market moved lower, it's been a smart idea to get out of that stock, take your short-term profit, and not really hold on to this thing. Nvidia down 10%. Again, seems unreal. I'm sure AMD is down. Google, in fact, a lot of these big tech giants, some of them, you think they're really safe. Some of them are not. I do like Microsoft. I am surprised that they're down. But something like Unity, which is going off of the metaverse, I would highly, highly take a look at stocks like this because the metaverse is something that's going to be way out into the future. And because interest rates are going up, guess what? These type of stocks that have their cash flows in the future are going to get hammered. They're going to get absolutely nailed and destroyed because, it's not as attractive to have money in the future when interest rates are so high today, because there's better investment opportunities today that have cash flow rather than these not so cash flow companies that are really highly dependent on the future outcome. So Unity, I would take a look at potentially buying put options here. Tesla, I got out of it. I told you guys that I'm out of Tesla for a little bit. I want to rebuy this stock at around $600 per share. I don't want to be in Tesla right now because there's so much risk in the market. And, funny enough, the whole market is down. So it's not just Tesla. I got out of Tesla, but still I am suffering. Amazon went down so much. I couldn't really expect Amazon post-split to go down. That's why I'm down 5%, 77K in 1 day. That really hurts. I mean, that used to be my yearly salary when I actually worked at Goldman Sachs. I was a consultant. This was around my salary out of college. So that really hurts. But, another stock that I would look into buying put options on is Shopify. Shopify has gone down 11%. Hims is actually a stock that I like. Now, other stocks that you can buy put options on is Baba, Snap. Oh, Snap has gone down so much. So Snap is another example like Coinbase. Snap has gone down to the point where it seems like a value, but I would still be careful. And we can actually look at Snap put options. Let's go into trade Snap options. Let's go into buy a put option. Now let's say that we think in the next, so let's actually go out a month. I showed you a 2-week example. Let's go out about 1 month. Today is 6/13. Let's go for 7/15, about 30 days or 31 days, something like that. Buy put option. And now let's go for an in the money put option. What I mean here is you can actually buy options that are in the money. So rather than going for let's say the 12 strike price, it's going to be a little bit of a variation, going to be very interesting right here, because instead of buying a 12 put option and needing Snap to go down to 12, you can actually buy a 14 put option. It's already in the money, so it's going to start benefiting really quickly. And actually, the reason why you might want to do this is because the delta here is 0.53, so you have a 53% chance that this option is going to stay in the money. Now, if Snap falls down by $1, which isn't that much, right? That's going to be pretty easy for Snap to do if the market continues to be bearish. In fact, I can see Snap going down to like $9. If the stock goes down by $1, this option is going to increase by 53 cents. Hopefully that makes sense, that it's going to go down by $53 because a $1 move is going to be a 53 cents move, and each option is 100 shares, so it's going to be a $53. So this option is actually going to increase in value. The stock is going to decrease, but this option premium is going to increase. So you bought it for $172. It'll likely be trading for about $2.20. So you can turn, 170 bucks into $220. Not too bad, that could be pretty quick money. Or you can also turn $1,700 into $2,200. Not too bad. Again, $500 that you can make on a pretty small amount of capital, as long as Snap just goes down by $1. Now again, that $1 move is going to translate into a 53-cent move. If I go down from the 14 strike to the 12 strike, the delta is going to be a lot lower. So now if Snap goes down by $1, you're only going to make about 30 cents or $30. So basically what I would be doing right now, if you want to protect your portfolio, is buy put options on stocks that you think are going to go down, whether the tech stocks, cryptocurrency stocks, social media stocks, or any other number of stocks. I would just not do it on oil right now. I would just pick something that is in bearish territory, that has a good volume and open interest. If you want to ask me any questions, make sure to join the Discord community in the first link in the description, and I'll see you in the next one.